Okay, it looks like attendee numbers are stabilizing now, so we'll get started. So once again, welcome everyone to TI's Ocean and Air Freight Tracker Outlook webinar for Q2 2025. It's good to have you with us once again, and this time for probably our most interesting quarter, I suppose, since COVID, with all of the drama around tariffs and trade and the restructuring and rebalancing and recalibrating that we're having to do at the moment in both the ocean and air freight market. It's a really interesting time. So the analysts today will try and take you through what the data is showing on how the market's performing and how we can adjust to relate to that. But it obviously is a very difficult time in the industry, and certainly one that really we'd almost say is more characterized by mitigating against risks really than it is around growth. So a lot of the actions that are taking place in the market, both into actually on the carrier side and on the shipper side, are all about trying to sort of mitigate those risks and deal with some of the short-term challenges that we see. So it's a very interesting market. Now, today's session itself will run for about 30 minutes or so while we're presenting our results, first on ocean and then on air freight. And then we'll have a Q&A session at the end. So there'll be 10 minutes or so to go through as many questions from you as we can at that point. So please do feel free to ask questions via the Q&A app on Zoom as we go through, and we'll deal with them at the end. I should also say that a recording of the webinar session will be sent out to all attendees and actually all registrants after this. So you'll have the chance to see the webinar again and share with any colleagues or other interested parties you want to. And we'll also be sending out copies of both the air and ocean freight reports again this quarter. So you'll receive the headline analysis from the global reports. But of course, if you do need the extra detail, the full global sections and then the lane by lane analysis, then please do get in touch with TI. We'll be very happy to take you through all of that data. Okay, so the next thing is to introduce you to the panelists, really. So I am Michael Clover. I'm your host, and I'm TI's Head of Commercial Development. For any of you that don't know TI, we are a market research firm dedicated to the global freight and logistics industry and providing insights on the development of the market. That can take the form of both this operational data that we're going through today on the air and ocean freight markets, but also in more strategic terms, longer term forecasting and market analysis of performance of different logistics markets and sectors. So, that's TI. And I'm joined by our analysts also from TI. First of all, Nathaniel Donaldson, who's our data team leader and leads a lot of the work on the tracker reports we'll be taking a look at today. So welcome, Nathan.
Thanks, Michael, and hello, everyone.
And also we're joined by Janan Hassan, who is one of TI's economists and analysts here, and again, instrumental in the development, design and analysis of the air and ocean freight markets for these reports. So Janan will be here to offer her views as well. So welcome, Janan.
Thank you, Michael, and hello, everyone.
Great. All right. So we'll move on to our first content session today. And the section here is on the global ocean freight rates development. And this is basically TI's index of all lanes showing how rates have developed. And I think, first of all, what's quite interesting here is actually that the index shows quite a flat picture for the last few months in Q2, even though we've had such a topsy-turvy market with so many changes. And that's because it's sort of amalgamating various different lanes, of course, and also obviously all of the supply and demand side factors which have sort of led to the rates that we've seen over the last few weeks. And should also say in the last couple of weeks, we've also seen the rates ticking up on a lot of lanes again, in spite of all that. So there's lots to get into to try and explain the trend that we've seen in rates in the last few months. And to start with, Nathan's just going to give us the headlines and a background on what's been happening.
Yeah, thank you, Michael. So yeah, it is a very interesting story, and this is obviously amalgamation and of weekly prices, weekly rates, and on different lanes, on the major lanes. But if we have a look here, basically the story that we see is US trade policy has created a very chaotic and rather, well, very uncertain ocean market landscape. If we look at the actual numbers, then the head haul index is extremely flat in quarter two 2025. It's at 138.1 in the middle of May. Now that's very little change versus March and versus February, but it is down 88 points versus the start of 2025 and down 73.2 points year on year. So if we look at the overall trend, well, we saw that rates fell throughout the second half of 2024. Now this was largely due to overcapacity, weak demand, and then inventory corrections. There was a clear Trump-induced bump that we can see at the start of 2025. Now that's in the month of January, so that's a contrast to what we'd expect to see with the seasonal changes of that post-peak time. But the high levels of uncertainty has resulted in cautious shippers, coupled with overcapacity and an artificial scarcity, which is keeping rates flat and preventing that further fall. But we have seen a significant fall due to uncertainty, the higher tariffs, and it discourages the larger volumes that we've seen. And actually, if we look at the data and the latest data, we can see that volatility is really reduced. So the average month-on-month change in quarter two was minus 0.3 points. Compare that to the final 5 months of 2024, that was minus 25.2 points month on month. And of course, that is a combination of all major rates, and that's the head haul rates that we're looking at in this analysis.
Yeah, thanks, Nathan. So very interesting, really. And I think one thing just to say is if you do want to look at the lane by lane analysis, then you need to sign up to the reports, and then you'll be able to access all of the lane by lane analysis, but of course also the data that sits behind them as well to see how it's all developing week by week on each of those lanes there. So that's the overall picture on global rate development. We're now going to look at the global volume picture as well, but breaking it out by region here. And Nathan's just going to describe what's been taking place.
Yeah, thank you again, Michael. So here we're looking at quarter one volume. So this is the complete data that we were able to get from port authorities at the point of creation of this paper, and the next paper will involve quarter two. But generally what we see from the major ports across regions, and TI has created an index for this, is volumes grew year on year 6.2 points globally, and they grew from quarter four into quarter one by 1.2 points. Now, that's really interesting. That's not what we'd expect seasonally again. So we'd expect those volumes to be falling. And that's that Trump-induced demand that we're seeing in the volumes. So we're seeing that shippers pushed through volumes, added pressure to the market, and we had that bump in rates at the start of the year. Now, unsurprisingly, this was driven largely by North American ports. They made up 11, so they were 11.2 points up year on year, out of the global 6.2. So largely American ports affected. European ports increased just 1.7 points, and Asia Pacific increased 5.3 points. So the demand pressure has departed from its usual seasonal trends due to the policy factors, and this is really evident in Asia Pacific ports, where volumes increased 3.1% quarter on quarter, and that's in the sharp contrast to a 15-year average of minus 4.5% quarter on quarter. So initially we had those large effects on the volumes, but as we headed into quarter two, we've seen less effect as the tariffs have reduced the demand pressure. But initially we saw that pressure that caused the bump. A bit latest data will show lower demand pressure and lower increases in the volume index.
Yeah, and I suppose in more recent weeks, it's all been characterized by responses to the changes in tariff policy, rushes to get inventory in place, and so on. And actually, there's something that's a bit more apparent really within the air freight market. So we'll come on to some more analysis of that when we get to the air freight section as well. But if we turn now to the supply side, really, and just take a look at what's happened with capacity, because obviously a big defining factor in what's happened with the rates recently has been the way that capacity has been attempted to be managed to help deal with some of these challenges from the change in trade policy. So Janan's going to help us try and understand what's been taking place here and what to expect.
Thank you, Michael. So we've seen a slight fall in capacity from April to May, and it's decreased 0.7%. The Trans-Pacific and Transatlantic lanes saw a decline, and the only monthly increase was on the Far East to Europe lane. That's possibly due to shifting capacity because of the tariffs. Quarter on quarter, capacity increased almost 3%, and compared to quarter one last year, there was almost a 5% increase as well. So, judging by the quarterly and yearly statistics, the main issues with ocean freight market this quarter seem to be overcapacity and fluctuating demand. So, artificial capacity restraints and managements are important to maintain profits, and these are practices we are likely to see more of in the short to medium term. This played out with blank sailing. Between mid-May and mid-June alone, some 7% of scheduled sailings were cancelled, and that's corroborated by reports of sudden capacity shortages on the Trans-Pacific route. Also, several alliances and carriers have suspended weekly service loops, particularly on the Trans-Pacific route. Utilization has also been on a downwards trend, with reports indicating that some ships leaving China were at a significantly reduced capacity than usual. So moving on to fuel prices.
Yeah, okay.
Last quarter, prices are on a downwards trajectory, and that's in line with the global crude prices. Bunker prices have been on a steady decline across the board. From April to May, bunker fuel dipped slightly, about 3% globally, with the Americas seeing the biggest monthly drop. Compared to the beginning of the year, global prices are down over 10%, and the Americas again leading the way with nearly a staggering 15% drop. And compared to the same quarter last year, prices are down even more, about 17% globally, with the Americas showing the sharpest drop of 21%. Overall, the prices are clearly trending downwards, and the notable decline in the Americas is likely due to the same lack of demand that caused oil production cuts in the US in the first place.
Great. Yes, very interesting to see what's going on the supply side there. So I think set back on capacity for a moment, we're sort of thinking about that in terms of the sort of risk mitigation from the carrier side, and obviously for shippers and forwarders, it's how to deal with that disruption and those changes in capacity as well. And that's where we've seen lots of companies employing different booking strategies and a lot more flexibility and short-term tactics really in dealing with that. So it's been a major characteristic of the market in the last few months and weeks, really. But interesting on the fuel coming down as well. Obviously, on the cost side, we're seeing that reducing pressure on rates. So that's part of the complexity, really, with the market at the moment. There's a lot to account for in terms of price shaping, and I think we'll now show you our ocean freight sentiment index, which is basically our index, which is designed to measure expectations for rate development over the next quarter, really. And actually, we've been running this on a weekly basis for the last few months to try and help show some of the volatility and change in the market and expectations. But this one shows the quarterly version. Now, Janan's going to talk through the ocean freight sentiment for us, but while she's doing that, I will launch the poll and ask you please to give your views as well as to what you expect to happen with the ocean freight rates in the last quarter, and then we'll run through that too. But in the meantime, can you run us through what the sentiment index is showing, please?
Of course. So this quarter, we're seeing mixed growth expectations for rate increases. On the Asia to Europe Northwest route, 55% of respondents expected rates to increase, and that's up from last quarter. And those expecting a decrease have dropped down to 30%, down from almost 40% last quarter. So sentiment is shifting towards a rate hike on this lane, but that's the only lane where respondents expected an increase. In contrast, 52% of respondents on Asia to North America expected a decrease, and that's up from last quarter's 40%. So sentiment is becoming increasingly bearish for this route. And finally, the Europe to US route, 48% of respondents expected a decrease, up 10% versus last quarter. And market expectations have flipped from rate increases on this route to rate decreases. Globally, the market views were split, but the majority expected an increase.
Yes, thanks. Thanks, Dan. So, I mean, very interesting also just to see the volatility in the results of the last few months as sentiment swings and changes around really. So, well, let's see how that compares to your views now on this session today. And I think if you can see the results there, which I'm sharing now, you see that there is a tendency towards rates increasing slightly. But I'll ask Nathan just to come in and give his initial take on those results. What do you think, Nathan?
Yeah, I think that's interesting, and I think it reflects the uncertainty that we see in the market, where we have a decent share of respondents replying to each, but with it edging towards the increase slightly, as maybe we feel like we've moved away from both the seasonal drop of Q1 and the start of the year and the larger levels of uncertainty to a more stable environment. So there's definitely the potential for some increases, but I think that kind of shorter term view that the reaction is more in the short term than the longer term still opens us up to some volatility across the board. So I think it's understandable to think that rates have fallen, and now it will allow some levels of increase, especially if the companies decide to use the capacity to allow that. But we still are open to a shorter term fluctuation, and that's why we're seeing those answers pretty even across the board on there.
Yeah, thanks, Nathan. Well, now we'll tackle the outlook as TI sees it as much as we can. Obviously, very challenging to provide a view on what is going to happen through the rest of the year, but you can see here TI's expectation, and I think in overall terms, this outlook grid is somewhat reflecting what the poll just suggested, and indeed what the data has showed for the last couple of weeks as rates have started to pick up again quite quickly, actually. But basically, this grid, the way you should interpret it, is that the arrows right at the bottom in the shipping rates row there show what's happening with rates and what our expectations for the next few quarters are. And that's all based on a combination of all of the other factors that you see listed above. And then above that, how to interpret that section? Well, basically, that's telling us all about what the expectations are for how each of those factors will influence rates, particularly. So not necessarily what's happening with each of those metrics, but what is likely the effect on rates themselves. So that's how you should understand this. And what I'm going to do now is just ask Nathan to offer his comments on any key demand side issues he sees, and then Janan will take us through some of the most important supply side issues influencing rate development. So Nathan, what do you think is most important on the demand side in the outlook?
So I think we have both the situation of the trade restructuring. There are lots of uncertainty as we have different trade flows. We have the longer term story, which we already saw change in trade flows, especially as we see the movement from China towards Southeast Asia, and Southeast Asia becoming a larger demand base. So changing, especially those trans-Pacific lanes, it could reduce the pressure on there. But then we do have potential of increasing pressure, both from consumers, as we see less inflation, we see increased wage growth and consumers adjusting to a new environment. We also see the potential for industrial demand growth, as we see less falls in that global demand environment that could encourage some levels of demand growth. And then, of course, the interest rates, which are improving, though that is now a changing environment as well. But this can allow for extra spending, it can allow for extra investment. So that demand should improve as we go throughout the year. But we do also have those other situations like the change in the actual trade restructuring, which could reduce demand and provide more uncertainty and volatility.
Great, thanks, Nathan. And Janan, what about the supply side issues?
It's an interesting picture. So right now, because of the current trade landscape, there seems to be a lot of regional mismatches in supply and demand. The industry will be shaped by some subtler factors as we head into H2 of this year. On the whole, importers are moving away from stockpiling to leaner inventories, and they're reducing their order volumes in the process. And we also anticipate reductions in EU-US cargo volumes, and that's likely to cause a ripple effect for the supply landscape globally. And carriers are reassessing transatlantic capacity. Shippers are taking alternative routes or they're front-loading their orders before the implementation of the tariffs. And for bunker fuel, major banks have cut their oil forecasts by about 6% since December last year, and the current production cuts are likely to continue into the year. So fuel prices going forwards are likely to push rates down, and the effect will be sustained in the short to medium term.
Yeah, thanks, Janan. So really interesting picture there. But I suppose obviously the big caveat or point on that is that any of these policy changes can have such a big impact on the outlook, really. And that's also, as both Nathan and Janan have said, there's so much regional variation, and that's also where we would need to look at the regional outlook grids you can get in the Ocean Freight Tracker if you sign up with us for that. So I'd encourage you to get in touch with us to have a look at those as well. Now, we'll move on from ocean freight now to air freight, which, if anything, is possibly even more interesting than the ocean freight market at the moment, especially as it tends to be obviously air freight where we get the reactions for the very short-term policy shifts to try and get stock in to beat changes in tariff policies or and so on. So very interesting situation here. And this is the global air freight rates grid, which works a bit, outlook rates chart, sorry, which will show us how rates have been developing. And Nathan's going to explain what's been happening and what to expect on air freight rates here.
Yeah, thank you, Michael. So yes, again, this is a simplification of a more complicated story. Now, this is a global level. We do also have the route levels, and if you do sign up and have the full paper, we do also have a spotlight onto the China to North America and China to Europe rates. But what we see here is that global head haul rates have dropped in Q2 2025. So they've dropped to $2.78 per kilogram. And whilst the backhaul rates have also fallen, they fell 3.3% to $2.33 per kilo. So there's a lot of factors here, including the overall trade situation and the preference and the fact that air freight can be a solution for a short-term transport. And then we also have the other side of the situation where we have the de minimis change. So to quickly focus on the de minimis change, which has had a large effect, and you can focus in on the Trans-Pacific lane and the full paper if you'd like to see more detail. We know that the change came in on May the 2nd, which would apply the de minimis change to all goods. Would apply the tariff and remove the de minimis change. Now, the latest agreement has now reduced the level of tariff on goods between China and the US, and what we actually saw was a 19% rebound in rates following that change in mid-May. And that's allowed rates between China and the US to settle around $4 per kilogram. So that's just focusing in on another story there. But generally, trade policy uncertainty is also a slight accelerator on the structural shift away from China and towards more local fulfillments, which could take some demand away from this large scale and global air freight rates. And we also focusing on improving demand from Southeast Asia and also more solutions from Southeast Asia towards Trans-Pacific. So there's lots of stories here. Generally, the rates are trending downwards, but there have been some volatility and some peaks, and we've seen some rises as a result of the improved trade situation between the US and China. But worth focusing in on the full paper to see that story.
Yeah, thank you, Nathan. And then on the volume side.
Yes, on the volume side, global air freight volumes fell in Q1 2025. So that's in line with the seasonal changes we'd expect. The index fell 9.2% quarter on quarter, compared to a historical average of this time around minus 10.7 points. So reflected reduced demand into Q1. But volumes did rebound really strongly in March. They were up 23.4 points month on month in the Asia Pacific region, 15.3 points in North America. So we see that effect of the global policies pushing that demand, pushing air freight as a quick solution, and also shippers aiming to get in before any new changes and this large uncertain landscape. So it reflects high competition for air freight for a quick solution for shippers to restock priority items ahead of new tariff announcements. We can expect the de minimis change to have a big effect here as well, as it potentially eliminates the price advantage of cheap consumer goods. And as I mentioned, you can see the full paper to focus in on the China to North America lane.
Yeah, thanks, Nathan. Had a huge impact on the market. At this time last year, of course, we were talking so much about the direct shipping models and a huge booster to the air freight market. So going to be some challenges there. All right, we're turning to the supply side now, and actually with like I say, really with capacity in air freight, there's so much more flexibility, and we've seen lots of chopping and changing around there. So it's really interesting, the picture to try and follow on the capacity side. And Janan can take us through it in a bit more detail.
Thank you, Michael. So utilized capacity in terms of cargo ton kilometers have been growing for 7 months running, but the rate of increase is declining. And in Q1, CTKs grew an average of 3%, and that's 13% down Q1 last year. Available cargo ton kilometers have also had a small growth quarter on quarter, and it's the smallest growth actually for the past 9 quarters. It only grew by 5%. However, it's still about 18% below the growth levels we've seen for ACTKs in Q1 last year. With the growth in supply slowing down, we can expect it to put an upwards pressure on rates. And it's also worth pointing out that capacity in April was reliant on belly hold, and the distribution between belly hold and dedicated freighters has held steady over the past year. Currently, it's a split of 55-45, with belly hold capacity taking the cake at 55%. And overall, these figures show that capacity is growing slightly faster than demand, but the gap is narrowing as both growth rates decline, which could lead to tighter capacity and potential freight rate increases down the road.
Okay. Well, we'll come on to that in more detail when we get to the outlook grid. But first of all, we'll look at what's happening in fuel, well, jet fuel in aviation. So if you take us through that as well, please, Janan.
Right. So the trend is not far off from the global crude trends. Jet fuel prices just continued their steady decline and fell across all regions on a monthly, quarterly, and yearly basis. Year on year, jet fuel costs dropped by 21%, around 4% month on month, and that marks May as the third decline in a row. And since jet fuel costs account for around a third of operating expenses for airlines, we can expect the continued decline of jet fuel prices to drag down operating costs and, in turn, to some extent, air freight rates as well.
Yeah, very interesting. So similar picture across both markets. Actually, we see the same in road transport as well with fuel prices. All right, well, we'll move on now to the air freight sentiment index, which works very similarly to the ocean freight one we described earlier. So Nathan will take us through the results of the sentiment survey we run. But in the meantime, I'll launch the poll for you to respond to. So Nathan, if you just take us through and then we'll wait for the poll results to come in.
Sure. So as a general overview of this one, it's been a very volatile and it's been full of change. I think I've used that word quite a few times, but it's been full of change recently as we've seen it drop significantly, and this is largely due, we would expect, to the changes in the de minimis policy. But generally, as we were looking in Q1, there was expectation for a moderate increase to significant increase throughout Q1. If we look at the start of Q2, that very quickly changed to an expectation towards a decrease in prices. But as we move from April into May, we move back into that place of increase. So just to provide a few numbers, globally, nearly 2/3 of respondents expected rates to increase in the coming 3 months. And then if we're focusing on the interesting lane, if we're focusing on Trans-Pacific, it's 70% of respondents expected some level of increase in the coming 3 months. If we compare that to the previous webinar, that's up from 58.9%. So from 58.9% up to 70%. So this is largely potentially that the expectation of a fall was largely the result of the first de minimis change, and then as we head into the expectation for increases, we see that it's expected to be less disruptive, and we do expect some levels of increase and some levels of normalization. But yes, back into an expectation of moderate increase for the air freight market.
Yeah. Very interesting. So I'll also just share the poll results now, and yeah, that shows the majority of people actually expecting stable prices, but also a tendency to go towards a slight increase as well. Any initial thoughts on that, Nathan?
Yeah, I think that makes a lot of sense, especially paired with Janan's analysis of the capacity and the fuel. We're seeing downwards pressure from the supply side, especially the cost side. There's a lot of uncertainty around the demand side, so we could see some levels of increase, but we're seeing downward pressure from the costs. So I think that makes a lot of sense for the coming 3 months.
Yeah. Okay. Well, let's take a look now at our outlook as well alongside that, so we can see TI's expectations for the next few quarters as well. And again, this outlook grid works just like the ocean freight one. So the bottom row shows actual expectations for rate developments, and then the rest of the rows show, what influence that metric is expected to have on air freight rates quarter on quarter. As you see, our expectations really are for a moderate increase of rates through Q3 and Q4, and that's our overall expectation. But I'll ask Nathan first of all to take us through key highlights on the demand side, which are influencing that over the outlook period.
Yeah, sure. So similar to what we saw in the ocean freight market, but maybe on a shorter time scale. So the trade restructuring is still having that effect, especially with the new tariffs and the improved compatibility of Southeast Asia. We also look a bit differently on the consumer confidence here because we're looking at the shorter term. We're looking at consumer goods right now, which are being affected by tariffs, and on a lot of those major lanes, we're seeing increased costs of those consumer goods, so reduced pressure, reduced demand and reduced pressure from the consumer side at the moment right now. We expect that to adjust quite quickly though. And then generally similar to what we saw before, interest rates is opening up investment. It's allowing greater spending as they fall, so we should see upwards pressure from there. And then inventory levels also expected to provide some levels of upward pressure, even though we might have some quite cautious shippers. And then the production utilization, we're seeing interest rates encouraging some production, some investment. We're seeing lower levels of inflation. So we could see some increase in demand from the production side, especially the tech side and the semiconductor side as we head through the year.
Yeah, thanks, Nathan. All right, and what about the supply side, Janan?
So like Nathan pointed out earlier, on the supply side, we can see that there are constraints that are becoming more visible. And behind the curtain, there is aging freighters, delays to replacements, and the seasonal nature of belly hold are all limiting factors for capacity. And that's a situation that will only be made worse when demand rebounds quickly. And for now, we can expect capacity to have an upwards pressure on rates in the short to medium term. On the jet fuel side, it's a similar picture to the bunker fuel forecasts. OPEC estimates that oil demand will grow, but that's a stark contrast with other estimates from the International Energy Agency, which has cut its demand forecast several times over the past few quarters. And although demand rose by something like 990,000 barrels per day over Q1, the expectation is for this demand to slow considerably to 650,000 barrels per day for the remainder of the year. So that's likely that fuel prices will have a downward pressure on rates going forward for both jet fuel and bunker fuel.
Yeah. Thank you. Yes, very interesting. I think also just one other thing I maybe would mention is just that so especially for the US market, we've seen such a lot of sort of rushed inventory into the US market. It's quite high inventory levels, and actually one thing we have seen, you can see this in data from the LPI, but the inventory holding costs are really going up in the US market as well. So I think that appetite for your rushed shipments through to beat tariffs may be sort of reaching a bit of a plateau for air freight demands while that inventory works through, because a lot of it's already in situ. So may also be a factor over the next couple of quarters there. Okay, so we'll now move on to our Q&A session. So thank you, first of all, very much to Nathan and Janan for sharing all those insights with us. So please, if you have any questions, use the Q&A app to ask those, and we'll turn to our first questions here. So I think it's probably quite a general one for you, Nathan, really, but it looks like it's on trade and demand and so on. So I'll ask you, which is well, what are the wider structural changes to trade that you mentioned in the webinar. Obviously, you talked a little bit about the movements towards Southeast Asia, but any other highlights you'd like to mention?
Yeah, I guess it's we see those focusing on Southeast Asia is the main place where we're seeing those changes, but we're both seeing it on a side of potentially reduced volumes between China and the US and a shift more towards volumes between Southeast Asia and the US. So this potentially could add some demand pressure to those lanes that are existing outside of that direct US and China relationship. But at the same time, we also see some increased demand from Southeast Asia within the Asia Pacific region. So at the same time, whilst we might see fewer volumes heading from China to the US, there's a growing middle class and growing demand from Southeast Asia, which could see a lot of volumes go towards Southeast Asia, both for direct consumers and for onward sale and to potentially to the US. So we're seeing potentially declining volumes between the US and Asia Pacific, so between the US and China, growing volumes between the US and Southeast Asia, and then also growing volumes between China and Southeast Asia, which means that the loss of demand from the US could be offset by growing demand from growing middle class in other areas of the Asia Pacific. So a significant change. And then also you have potential growth in demand and activity between Southeast Asia, so Vietnam, Thailand, to Europe as well, so Northern Europe, for consumer goods. So a lot of change going on at the moment, which is existing in and around the noise of the trade policy changes and the tariff changes.
Yeah, very interesting. I think also important to bear in mind that a lot of the trade change is obviously quite US centric, and there's all those dynamics between other regions as well, and obviously opportunities there from all of those changes with excess production needing somewhere to go, of course. So always important to bear in mind that while the US tariffs are changing things, there's a lot else going on in the world, of course. And that's interesting. It kind of brings us on to maybe a question on the capacity side now, which is basically asking, is it true that capacity will continue to shift between lanes, or is it more likely there'll be a reduction across the board? So, Janelle, maybe you'd like to tackle that one.
Yeah, it's very likely that we'll continue to see capacity shifting between lanes rather than broad permanent cuts. Carriers are in a tricky spot. They need to avoid flooding the market with too much capacity, which drive rates down, but they also can't afford to make services too unreliable. That's why we're seeing things like blank sailings being used as a quick tactical adjustment. That being said, overusing blank sailings can lead to negative consequences. So instead of big structural reductions, we're likely to see more flexible scheduling, maybe better forecasting patterns and tighter partnerships to move capacity where it's needed in a more planned and less disruptive way. For example, the recent capacity bump on the Far East Europe lane probably shows carriers repositioning ships to chase more profitable routes, especially as demand on Trans-Pacific falls. Overall, it's going to stay dynamic, and carriers will just keep moving pieces around rather than pulling them off the board completely.
Yeah, thanks, Janelle. Okay. Another question here, which is really talking about obviously the trade imbalance or structural imbalance for trade flows, east to west. And in part, that trade imbalance, I suppose, is what some of these tariffs are supposedly seeking to address. But the question really is just asking, what strategies can airlines implement to mitigate this imbalance and optimize aircraft utilization on the eastbound leg? So, maybe Nathan, that might be an interesting one to think about in terms of the changes to trade structure. Are there potentially any other strategies from North America back across the Pacific that may come up as a result of the change in trade policies, which could help with that problem?
Yeah, really, really interesting question. I would say, first of all, it is what we generally expect in logistics markets. I mean, you could be looking at the ocean freight, the air freight, you could be looking at the road freight market. We're likely to have a head haul and a back haul. And the head haul is likely to be well utilized and be more reactive to changes in demand, whereas the back haul is likely underutilized, less reactive to changes in demand, and likely the cheaper option. In terms of strategies that can allow these airlines or the forwarders to stay as flexible as possible. I think something that Janan mentioned is that usage of the belly freight is really important. So not committing yourself to provide capacity to an underutilized route, and therefore allow more flexible and dynamic capacity to be used outside of their networks. I think also what we're seeing here is we're in a bit of a time where we're not seeing those larger structural changes to the strategies and the systems of the airlines at the moment and the carriers. I think it's a hard environment to provide that, and maybe as we look in the longer term, we'll see them able to adjust to what the reality is. But I think right now carriers are more looking to short-term solutions to react to the immediate result, and maybe we'll see the solutions appear further as we look into the long term. But overall, we can expect a head haul and a back haul, and we do expect that the back haul is likely going to be underutilized. And actually, that often is quite an efficient way of operating these lines and these carriers.
Yeah, it's a sort of occupational hazard, really, but in a funny way. That option of using belly freight's a bit more possible if demand is somewhat lower. Obviously, you have to use freighter aircraft to cater to those huge volumes, and that was something that came in a lot with the e-commerce demand we saw through last year. There was no other option to get those volumes in, so the backhaul is to some extent a price you have to pay for that. But it does also lead us on to another question that we've had about belly freight. So probably one for you again, Janan. So you said that 50% of carriers are using belly hold for cargo. So how might this reliance on belly hold expose air freight to volatility?
That's a great question. The big thing with belly hold capacity is that it's directly tied to passenger flights. So when passenger demand goes up or down, so the space available for cargo, and that makes the market more vulnerable to seasonal swings and unexpected events like economic shocks or the pandemic. If passenger flights get cut back, cargo space can suddenly disappear, and that puts a lot of pressure on rates and availability, especially since freighter capacity isn't growing fast enough to cover the gaps. And we can see that with aircraft production delays at Boeing and Airbus, and that's only making things worse with very few new planes coming online right now. So really, this heavy reliance on belly space makes the market more unpredictable. And if demand rebounds quickly, we can see a situation where there just isn't enough space to go around, and that could push rates up pretty fast. Building on what Michael and Nathan said, a couple of strategies that can mitigate this imbalance maybe can be triangular routing. So airlines could design a multi-stop route to reduce the number of empty legs by picking up the slack, or maybe targeting other verticals like e-commerce, like Michael said, or uh, perhaps perishables like pharmaceuticals, where demand is likely to be more stable.
Yeah, for defensive sector. And I suppose also on the perishable side, from the US leg, picking up Central American or South American perishable soft fruits and things on the return leg may also be an option for that kind of triangular routing solution as well. All right, well, that I think brings us on to our last question here, really, which again is a bit like a bit about volatility. Probably one for you, Nathan, if you don't mind. And that is your global rates index appears to show rates are flat. And you mentioned greater chance for volatility and uncertainty, which I think we probably all agree with. There's lots of uncertainty, but when do you expect to see this volatility returning?
Yeah, I think this also follows on well from Janan's answer in terms of recognizing the potential for the volatility to increase when the market is a lot tighter. I think we're existing in a place right now where we're in a post-peak situation. The seasonal volumes and the pressure is lower. We're also existing in a place of large capacity. If this changes, so if we're heading towards a peak period, we're seeing a sudden increase in demand. The uncertainty is very much there. We've got lower levels of capacity, or capacity is less flexible. Then we might very quickly see a much more volatile market. So at the moment, we've got a lot of space. That demand pressure is quite tempered at the moment. But should that decrease and the uncertainty remains, and we have some of those shorter term shocks with less pressure, then we could see a more volatile market, maybe towards a higher demand environment in the peak periods.
Brilliant. Thanks, Nathan. Well, that brings us to the end of our session today. So thank you very much to both Nathan and Janan for sharing all their insights and data with us today. It's been a great session. And if you want to carry on the conversation or you want to get into any of that more detailed data that we've been plugging throughout the webinar, then please do get in touch with us. We'd be very happy to take you through the lane data we do have available and show you the more granular data on the dashboard that sits behind that. So please get in touch using the details on the screen to follow up with us if you want to. And the last thing is that just remains for me to thank you all for joining us today for another session, and we hope to see you next time. Thank you and goodbye.